Hello, everybody, and welcome to the Vancouver Resource Investment Conference channel. My name is Jesse Day. We are bringing the VRIC to you each and every week with our series of expert online panels. I'm very excited for the one we have to bring to you today. We've got Brien Lundin, the editor of Gold Newsletter and CEO of the New Orleans Investment Conference, and Tavi Costa, macro strategist at Crescat Capital. We are going to be talking, of course, gold, silver, the mining stocks, other commodities as well. I cannot wait to dive into it. Gentlemen, thank you for coming on the show.
Thanks
Great
for
to be
having
with
us.
you.
Well, I want to kick things off by getting your broad view of the gold sector at present. Obviously, it's been a very exciting time. Gold hitting new all-time highs, pulled back a little bit yesterday, climbing up again as we sit here on October 24th. But I think the long-term trend is definitely to the upper right of the screen. I'm wondering what both of your thoughts are. I spoke to Adrian Day earlier, and he said he thinks we're just getting started, that the table has just been set, and now that we're entering a rate cutting cycle, he expects the next leg of the gold bull market to commence. I'm wondering what both of your thoughts are there, and Brien, I'll start with you.
Well, thanks for starting with me because if I came after Tavi, I'd just say what he said because I'm sure we're going to agree, and he's going to say it much better than me. But all of that said, the distinguishing feature about this bull market, or at least one of them, and I think uniquely distinguishing feature of this bull market is that gold's going up regardless of anything and everything. We've had periods where it's been typically inversely correlated with treasury yields and the dollar index. And we've had many periods, some of them substantial, where gold has been positively correlated with yields and the dollar index. And I think in both cases, it's a sign of safe haven investing. In the latter case, when yields have been rising and gold has been rising, it's been an evidence of the fact that people are concerned. Well, the source of their risk is treasuries in general. What are we getting paid for by those treasury yields? Is that currency, the dollar, going to be significantly depreciated when we do cash in on it? And the yields currently aren't commensurate with that risk. And as Jim Grant is famous for saying, in some cases, it's even not the return on my capital, but the return of my capital. So that's a fundamental sign that the investors around the world are concerned about the global financial situation. And gold is in a special place because there's so much liquidity around the world, huge pools of capital, that just literally a fraction of a percentage of allocations around the world toward this relatively small sector of metals and in mining has a huge difference, will make a huge difference. And we're seeing that happen right now. We're seeing a lot of money for a lot of different reasons, but generally because of the value trade-off between gold and currencies going forward. They're going into gold, and the reaction has been so far spectacular. And I agree with Adrian, and I'm pretty sure I'm going to agree with Tavi here that we're just at the beginnings of this move.
Yeah, Tavi, your thoughts.
Yeah, I think Brien well said. My 2 cents on this is it feels to me that inflation is in the process of reaccelerating. I think gold reflects the surging gold prices reflects a lot of that. And the big concern from a policymaking standpoint is how much can the Fed and even other central banks really do to prevent that from happening even further? And that's really the kind of the end game and the opportunity for hard assets at this next, I would say, even decade. And gold is just leading the way. There's a lot of other things lagging that also present a great opportunity, in my opinion. But the monetary conditions and this need to suppress rates is becoming more and more evident. We're having other folks, and especially large investors, Paul Tudor Jones and Drug Miller, starting to talk more and more about the fiscal challenges we have. And to me, it comes down to one measurement that you can take on as much debt as you want, as far as not I shouldn't say it unlimited amounts, but certainly the US can add a lot more debt to GDP levels. What it can do is to be spending 4 to 5% at a minimum of GDP to pay for that debt. And I think we all here know that that number is only going to grow from here. And so that really suppresses, it creates actually an amount of known growth spending relative to growth spending from a fiscal standpoint that is very problematic. And so what does that come down to? Probably suppression of rates. So the Fed, this whole talks that we engage on, myself included, on where labor markets are going to go or inflation is going to go are kind of meaningless because the Fed has to cut rates regardless. And they're going to take that card. We all know illegal immigration happened to a way that we haven't seen in the economy for, I don't, maybe, I know in many decades, I'm not sure if ever, but in many decades. And if we looked at that, for instance, as a way to measure the issues that we're seeing with the mixed messages in the labor markets, the Fed is going to take that card regardless. They're going to say that there's a lot of deterioration in that front, and that justifies cutting rates by 50 to 25 basis points here in the next meeting and the next meeting and so forth. And when I look across the globe and I think about, okay, well, how much are we spending, federal and local relative to GDP, close to 5%, and other economies are spending all 2% and 1%, European economies, Japan, Canada. I think that the sense of urgency from the Fed to actually cut rates is even more or even greater than other places. And so you would think that that would have an impact on the dollar. How will hard assets behave if the dollar depreciates in the next 1 to 3 years, which I think will happen? It's a big question. And so I do think this is a real movement. Concerns me a bit about the inflation front because I do think that means inflation is coming. And the big opportunity as well, just to finalize my thoughts, is that think about that headline from Wall Street Journal that said gold loses reserve status in September of 2022. Gold prices were at $1,600 an ounce. Today we're about over $1,000 more. And I don't think that the cost to mine has gone to the same level in terms of the increase. Yeah, it probably went up, but I don't think it went up $1,000 an ounce. So you think about that margin improvement on the mining space, it's starting to get quite attractive. But hey, who am I to say that? I mean, the market has been broken and nobody cares about mining stocks. I love them. I think Brien loves them. I think most people that have some brain cells would agree that looks extremely cheap and undervalued. But I think at some point people are going to realize that ultimately metal prices do drive fundamental improvements of mining companies, and you do have decades that those companies can lead the way on the upside. And I think we're entering one of those.
Quick break here. This episode is brought to you by West Red Lake Gold Mines. Now, if you know nothing about West Red Lake Gold Mines, let me tell you one thing. This company was founded on the back of a transaction where they purchased the Madsen mine in northwestern Ontario in an area called the Red Lake Gold District, which to date has produced around 30 million ounces of gold from some of the richest gold deposits in the world. Now, what they paid for this mine versus what they got has led legendary mining entrepreneur Frank Giustra to call this transaction the deal of the decade. And Bob Moriarty, founder of 321 Gold, was recently on my show calling West Red Lake Gold Mines one of the two most undervalued gold companies in Canada. If you're curious why these individuals are so excited about West Red Lake Gold Mines, hit the link below to learn more. Now back to the episode.
And I definitely want to dive into mining stocks in just a moment. First, I'd like to touch on silver, obviously nowhere near all-time highs, but performing quite exceptionally when you consider its hit levels that it hasn't hit in 12 years. I think we're sitting just above $33 at the moment. There's been a lot of talk thrown around about $50 silver. Obviously, people like nice round numbers and back to previous all-time highs. But I'm wondering what both of your thoughts are, because a lot of people I speak to think silver is extraordinarily undervalued and extraordinarily underappreciated by the market at large. And when it comes to sentiment, I guess I could say, judging by just comments online and social media, I know of no other crowd that can be more despondent than silver stackers. So I'm wondering what your thoughts are on the silver space at present. Brien, I'll start with you once again.
Yeah, silver's easy. It has always leveraged gold, always outperformed gold in a long-term, monetarily based bull market. Therefore, it's likely to do that again. And but because it is, a smaller market and yet less expensive. So it's kind of the poor man's gold. I hearken back to what my mentor in the industry, Jim Blanchard, who started everything that I started here back in the mid 80s when I started working for him as a junior copywriter. He was telling me about the market and he said, Brien, always remember that gold bugs are crazy, but silver bugs are effing nuts. And and it's been proven true over and over and over again. As much as gold, and Jim could say that because he was both a gold bug and a silver bug. And as much as it's been proven over the years that gold is a religion, as it were, and has its advocates and acolytes, silver is just all of that to a whole nother level. It's to the power of two, and it's going to move again. But one of the most exciting areas to me is the fact that silver is doing what it always does. It's a little bit late to the party, but it is leveraging gold right now. It's got a lot of room to make up on a percentage basis. But on top of that natural leverage that silver provides to gold, you can get leverage on silver through silver stocks. So that's where I think we're at an exciting starting point, and a little bit past the starting point. I think the gun's already fired, but we're taking our first steps in the race on the silver stocks. They offer tremendous leverage, tremendous upside potential right now, and that window's open, but it's closing quickly.
And Tavi, your thoughts on the silver space and maybe to the question of when this sector is really going to take off. Timing the market is obviously impossible, making these predictions a mug's game, as many people say. But a lot of people have been waiting a long time. And if you bought silver back in 2012, you're now getting back to the level of which you purchased at. I mean, adjusted for inflation, obviously you've lost money. Is this a situation of silver takes a long time to get going, but when it does, it truly outperforms?
I think so. I agree with Brien. I do think that historically that has been the case. And when we put into perspective the move we've had recently, you know, thinking back where we were with the gold to silver ratio during other times that were kind of pivotal for precious metals. 2003, the gold to silver ratio peaked at about 81, I believe. In the global financial crisis, we peaked at about 84, I think. And today, we recently peaked at around 81, excluding the COVID era. And so when you think about that, I mean, there's definitely a lot of room for silver to outperform gold first and foremost. But thinking about from a behavior standpoint as well, it's important to notice when you have days that the metal is up or down, that silver is outperforming gold, and a lot of times, especially on the upsides. And you have as well the mining companies is starting to outperform gold itself, which is something that a lot of people have given up on. You're starting to see the junior miners outperforming the seniors. And I'm talking about in the last few weeks. And the last thing that is important as well is that the TSX venture, the most hated part of the whole industry, is also starting to get some love. And these things can have very large and explosive moves and when they start moving. And so I am extremely attractive from that standpoint as well. From a supply side, silver is interesting as well, because if you look at the two largest producing countries, Mexico and Peru, in combined actually have, go back to I think 2013 or so, or the peak production levels. We're about almost 30% lower from those levels now. And knowing that there hasn't been many major discoveries of silver and also almost no developments of silver mines, I'm not sure where the production increase will come from to match those levels again. And so, and again, think about where gold prices are. Gold is about 40% higher than where 2011 levels were. Silver prices in comparison are 30% lower than that 2011 peak levels that we saw. And so, for those, in my view, looking for a catch-up opportunity, that's probably where to be looking at. And so, extremely exciting, and it's not an easy game per se to find silver assets outside of owning silver itself. That is a challenging game, unfortunately. But there are some great companies out there that offer you that type of leverage to the price of the metal as well. So it's an exciting time. It's exciting because a lot of people are focused, in my view, in the wrong things. And there's a very few number of people that are actually doing the work and really trying to think about this long-term cycles that we tend to see in commodities and metals and mining and emerging markets. They're all linked, and looks like we're probably onto another one of those here in this coming decade.
Yes, and I would like to talk about the mining stocks now. And speaking to your view of people focusing on the wrong things, perhaps it's a bit of a sign that Tesla is ripping, and now we're seeing Newmont down 14% so far, at least last time I checked today. We're recording this on October 24th after releasing an earnings report. Several other names in the sector also in the red, while gold is going up. What do you think the reason for this is? First, let's focus on the Newmont issue first. I'd like to get both of your views on why the 14% drop. And do you think the big producers, Newmont, Barrick, Agnico, etc., are still fairly undervalued and present opportunity? This time, Tavi, I'll start with you.
Well, the Newmont stuff is interesting because they've been guiding higher production and cost actually not going much higher. And now, they surprised the market with something completely different, right? The production side didn't look like it's going to be, in fact, it's going to be flattish lower and for the following years. And the same thing happening on the cost side. On the other hand, we're going to see an increase, and so normally that should hurt the market. I'm not as bearish as the market is personally. I do think that those margins are still looking great, and I don't see any issues structurally. I think that the majors are unfortunately lacking the vision, and I can say this with confidence by looking at some of the statements actually said by Newmont, and I think that they said something about being focused on creating value rather than volume. And I think there's something to be said about that. In my view, that's a mindset of the last 10 to 15 years of an area that has lacked capital interest and a lot of difficulty to navigate the market, that has forced most of these management firms or companies to have their management solely focus on our capital shareholder friendly policies and trying to avoid growing too much and overpaying for assets and other things. While that sounds great, when you look across the industry, yes, Newmont may look very undervalued and you may use some of your excess capital to buy back shares, but think about how your company itself and seeing the depletion of reserves and not seeing look at Barrick, for instance, take a chart of Barrick for production of gold over the years. Boy, I mean, it's been just a straight line lower. Any other industry would have fired that CEO, any other industry, right? But in the mining space, that seems to be normal. I don't understand what's different here. I mean, any other industry would have seen an activist approach coming in and saying, we got to clean this up. Who is doing this mess? But I'm not here to do that job either. But what I'm trying to say is there are times when you want to focus on volume, in my view. There are times, and especially when things are extremely cheap. If you're able to buy these things, your share is cheap, but you have access of capital that you're creating through the generation of your assets through free cash flow. You should probably be redeploying this into growth, especially when the entire industry is not doing that. And so I have a different view on this. I actually think they should be focusing almost entirely on volume, given the fact that that's what's going to create value in the future. And it may not create value now, but that's the time to be thinking about growth. When you think about that same process that technology companies did back in the 90s, which today they're a bubble, but back in those days they focused almost entirely on growth. That's what we're lacking in the mining industry, in my view, is growth. And it's easy to say this because the last time we saw something along those lines, people were misallocating capital, they're overpaying for assets, and we had a bubble in the gold space, but that's not the case now. No, we're on the other side of this. These companies are extremely cheap. And if you're looking to expand and become a much larger company, and avoid, being, the dinosaur of the last cycle, then, this is your opportunity. And unfortunately, I'm not sure if it's shareholder pressure, if it's board pressure, or if it's coming from CEO and management issue. But there's something wrong with the thinking of the vision of these companies, and that concerns me. But it's also an opportunity. So that also excites me as an investor.
And Brien, any thoughts you'd like to add on Newmont being down and also on the discussion surrounding the big producers? Do you also see that same lack of vision, and do you see any value in any of those major companies?
Yeah, I would say that Newmont's kind of a special case. You can argue about how they're managing the company, but the primary lesson that we're learning today is that they didn't manage expectations very well. And what we're seeing, or what we have seen since really early August, is that generalist investors are starting to come in to the major miners. They started buying gold through GLD in July, and then they started coming in and pricing into pivot by coming into the miners. And at least, they're paying attention now. The fact that Newmont's down 14% is evidence that the big money's at least paying attention to the market. But those new buyers of the mining stocks are soon going to have completed their research into the mining sector, and they're going to think they're awfully smart, and they're going to start looking at reserve replacement, as Tavi just mentioned, and that will be important for the miners, but also to the juniors that are going to supply those reserves. I don't expect to see much from Newmont on the M&A front. It's kind of a special case again, because they're still like the python that ate the pig. They're trying to digest Newcrest, and they're doing a lot of internal work, rationalizing those assets, trying to divest non-core assets and gain control, and see where they're finding those synergies. But they've already found more synergies than they in the market expected over the last quarter in that regard. So they seem to be doing a pretty good job of that. But the M&A is going to come from other sectors, and like like silver outperforming gold, like the mining stocks outperforming gold, it happens in every market. And typically in a bull market, it would have happened sooner that we would see the majors go on an M&A spree. But they have been conditioned over the last 10 years or so to be better guardians of shareholder capital and not be like drunken sailors spending money. But again, that's the process that's going to happen. We will at some point see bidding wars and the like. It always happens. And as investors who are heavily invested in the junior mining sector, we want them to be spending money like drunken sailors. Frankly, I don't have any positions in Newmont, but I have positions in a lot of companies that want to sell their projects at much higher prices to Newmont. So it's going to happen, and I think it's something we want to see happen.
Let's step outside of the majors and talk about where you're both seeing value in both the gold and silver space. So, obviously there's not a lot of major silver producers, but feel free to discuss those as well. Are you looking at the developers and the explorers at this point in time? And how are you evaluating the sector in general when you're kind of looking over the landscape and deciding where to deploy capital? And Tavi, I'll start with you on this one.
Yeah, I think exploration is still a focus for us, and it's still something we continue to have in the portfolio. I think one thing we added to, I guess, our way of expressing this bullish view in metals is to also try to acquire some private companies that are in the production stage. There seems to be some value there to be able to unlock. And we've had the success of the San Cristobal mine, which is seventh largest silver mine in the world. with a major discovery nearby. And it's also a very large zinc producer. And so, but that, still a private company. And that has allowed us to kind of have, sort of the the hands on the wheel of a vehicle that could potentially do what other major companies are not doing and focusing on not only exploration but growth of resources as well. So we've been using that accordingly. But we are also in the process of purchasing other assets. It's kind of why I've been so busy as well with trying to acquire another large precious metals asset in North America. In the private side, also free cash flowing generating asset as well. And I think that has been a key sort of way to hide in markets that have not only remained really cheap when it comes to, a lot of these assets are being sold with, I'm not joking, with gold assumptions of $1,800. And so, if you're going to calculate the NPV of a company at those prices, I'm very interested. And so we've been looking for those. Of course, anything that is being sold today has some level of hair. Nobody is just, getting rid of those assets without some issues attached to it. So you got to get comfortable with how you're going to approach that. But there's no shortage of opportunities in that front. So yeah, we've been getting our hands dirty in the more later stages of the industry more recently, but more on the private side. So we don't own any of the public large companies like Newmont or anything like that, although we work with them on the side. And so that has been a place where I've actually been spending most of my time and capital as well of clients too. So outside of that, the exploration stocks still look really attractive. Nothing has changed from that view. I still think there's a wonderful way of playing this kind of venture capital hybrid approach in this space of deploying capital in a lot of different companies that we believe have high quality assets and probably onto something large and scalable, and that could be sold to a major company. And if those boxes are checked from a expectation standpoint, we're probably going to be investors. And so there's some exciting stories, not only that have been in the portfolio for a long time, but new stories too that have been coming into the portfolio more recently that we are looking forward to seeing some of those drill results and how they shape up those stories in the near future. But it's a great time to be looking at these things, and I feel somewhat blessed of being in the industry now, not as long as Brien, and I'm nowhere close to the expertise level of these guys, but I would say that it's been a tremendous ride, understanding and trying to I guess view this industry that is just such a complex industry, but that has so much value, in my opinion. It's like a true legacy business model, has been here for many centuries, and that, in my view, has a very low multiples of valuations that potentially, with gold prices and other metal prices, has a secular growth sort of movement on the backside, which could be a tremendous change of valuations and also a way of deploying capital and making a lot of money. So that's really where I think the wealth creation, at least to me, would be my focus on.
And Brien, where are you looking for value right now in the gold and silver mining space? Are you looking at the explorers? Do you do any private deals? And are you looking at developers? Where are you looking right now in both gold and silver?
Yeah, pretty much all of the above. It's hard to determine value in exploration stocks because they are burning matches. But I guess like Tavi as well, cannot resist a good exploration story. And there's a bunch of them out there. But in particular, I think we are at a stage of this market where there are a couple of areas that offer a lot of potential. One, as we kind of touched on before, would be the silver stocks, silver exploration development stocks. With silver finally responding, they're going to offer leverage on top of silver. So it's bam, bam, doubling your leverage on that. And they have a lot of upside potential. Another area are the companies that have really big resources, from exploration stocks that have discovered big resources that they've defined them, they have resource estimates, in some cases they have economics, In other cases, the so-called optionality plays, the resource banks of the past 10, 15 years that bought big resources that were lower grade, were uneconomic at then current metals prices, and hoping for kind of an explosion in value when prices rose. Well, we've had that. All of those out of the money optionality plays are now wildly in the money. Those big resource stocks development companies that have really big gold resources being valued at less than $10 in the ground right now. There's lots of those around. This rise in the gold price has been so stunning in its ascent and somewhat confusing and disorienting, at least from at the beginning, from where the buying was coming from, that the market has yet to re-rate these companies. And the numbers are so stark right now that I think that re-rating is coming over the months just ahead. And there's a lot of opportunity in those companies as well.
Well, let's delve into the exploration side of things a little bit more. I'd really like to know how both of you evaluate and look at exploration companies, because obviously that's a specific skill set that requires a very specific knowledge base. So if you could also maybe shed some light on that as well. For myself personally in the precious metal space, I'm an ETF guy, and people say you spend all day talking to people who are experts on the precious metal space and you turn around and buy the like GDX or whatever. And that's because the more I speak to experts such as yourself, the more I realize, wow, this is a really difficult thing to do. And if I have conviction in the sector, then I'd rather take the lower risk approach. But for those who maybe are willing to put in the time and effort, how do you approach what sort of knowledge is required to look at exploration stocks? And then how do you use that knowledge to then evaluate companies and determine where's the best place to deploy capital? Big question. Take it wherever you'd like. Brien, I'll start with you on this one.
Yeah, one of the things I tell people is this is an extremely inefficient sector. So if you're willing to outwork people, if you're willing to spend some money to one of the best newsletters, subscription-based business model newsletters, where the editors are working for you, go to conferences, talk to companies, listen to people like Tavi, listen to those experts. There's a lot of information out there, and you need to try to get stuck in that information crossfire. If certain companies are mentioned by good people, respectable people with track records over and over again, that's where you should look. But beyond that, there's a lot of key factors you need to look at. Obviously, management is one of the key ones, the more important ones. Management groups that have had successes so that what they're working on now, they're more concerned about their reputations than making more money in the sector. There's a few groups out there like that, and you can look there. Another key thing is once you have that body of knowledge or gaining that body of knowledge, get early. The earlier you can get into these plays, especially in a bull market environment, it mitigates your downside risk and expands your upside potential. So getting in early through these sources by going to conferences, subscribing to newsletters, the next big deals by good management groups, that's where you can make a lot of money, frankly. And the key as well is to mitigate your risk. Avoid the losers. So that it also involves a buying and selling strategy that in some cases you really need to pay a lot of tuition to learn. I've paid that tuition in a few cycles and not, in a lot of cases, the lessons were harsh. So sometimes you have to get beat over the head in the market before it really sinks in. Try to avoid paying that too much of that tuition. In a market like this, buying and selling strategies are key. Taking money off the table is going to be key to being a success over the long term.
And Tavi, how do you evaluate exploration plays and determine if it's worth deploying capital or not?
Well, I think it comes down to understanding the history of exploration, how we have seen the changes of valuations in the space. And, the exploration game is very different than a cash flowing business. By definition, when people get mad at companies that are diluting and other things, No, just know that that's going to happen. There's no way around it. That's the only way. They're not in the business of generating cash, so they're going to have to dilute, and it's just really a question of how smartly they can do that. So that's number one, understanding it, feeling comfortable with that. But number two is how the valuation works. Usually throughout history is what is the value of that mineral in the ground. So, assuming you have, $10 billion supposedly worth of mineral in the ground, in a bull market, you can see a market actually valuing that $10 billion resource at levels like, we've seen actually 50 to plus even 70% of that resource being valued. So, you're basically selling an asset that has, call it $10 billion of resource, selling it for, $5 to $7 billion worth. I'm just giving you, these are not specific numbers to a certain company or anything like that, but just to give it the easy math. But in the bear market, on the other hand, you can see that that swings to the other side. We've seen as low as 3%, okay, being paid by a resource. So now, what is the median? Right? The median is about 20%. So it could be arguably slightly, smaller than maybe 18%. So, so we can kind of make an assumption, if you find a wonderful, $10 billion worth of a deposit, you're probably going to be being valued at the market in a very conservative and historically speaking, probably about 20% of the value would be your peak market cap. Okay, so now you understand sort of how the Lassonde curve works, right? The Pierre Lassonde curve sort of works. And so you can kind of go from there. It's a very technical part of the industry in which you rely a lot of that on technical folks to kind of tell you where the potential is for the size of those deposits, and then you can value that on a dollar base and kind of see what your expected market cap would be if you actually get into not only a bull market but also into coming to fruition of finding those discoveries. Now, how do you get to a successful discovery is a really big question, and I wish I knew the answer as well. We've made a lot of investments. Some of them went very well, and some of them went really bad. Majority of them were really bad, and that's okay. That's just part of the kind of that venture capital hybrid approach that we are taking. And I would say that capital structure is a really important aspect. I mean, I would rank that as one of the top things to look into it. Especially you talk to a CEO. How much does he own of the company? Make sure there's real skin in the game. Otherwise, there's some great companies with great assets out there that unfortunately, we've been investors and things have not turned out well. And I would blame it almost entirely on the cap structure, almost entirely on the fact that the CEO was just not incentivized and aligned to perform. And so that's a really big problem of this whole industry. Another thing is the flow through things that we tend to see through this whole industry, which are very cheap, supposedly cheap dollars for at first, right? It looks like it's like we shouldn't call it cheap because there's nothing more expensive than those dollars that come through. But it really is a mechanism for Canadian companies to raise capital much easier with flow through funds that tend to provide that capital every year for tax reasons. And guess what? In a year from now, they're going to be big sellers of your stock. And these companies stay on this cycle of raising money through that to pay their salaries and never get out of that. And so, be careful to not be buying one of those assets because there's a lot of them are in that position today. And especially given the fact that there hasn't been any capital interest, a lot of good stories have to be had to go to that route, unfortunately, which I think it's a very dangerous path when you go there. But and not to say that there hasn't been, and if the asset is a great asset and you may be taking some flow through money and other things, you might still deliver. But we're talking about finding the best probability game here to succeed. And I think that's a big aspect of this whole industry. There's a lot more that I'm missing, but you ultimately, I think, to be worth the dollars you're spending and the timing you're consuming there, it needs to be something scalable. If you may not have the necessary base information right now to make a case of a large deposit, but you have to at least make that case that in the future, things could potentially grow to a size that will be of a potential acquisition to a major. Otherwise, it makes zero sense to make that investment in the first place. And lastly, I would say, one thing we focus at least, and this is not a science as well. This is going to be, people will have different opinions on these things of jurisdiction risk. We like to buy mines or potential mines that are in jurisdictions that have developed large projects in the past. Again, very smart investors will have extremely different views on this. And it comes down to having conviction on that aspect. And this is kind of a game of any investing, right? Investing to me is not trying to be too cute. It's having conviction in your story. So when you have the prices being irrational and falling because of whatever happened in the news or just a large seller a large shareholder being forced to sell the name and hurting the stock or something along those lines. When you're in those positions where your conviction is challenged, you want to have a very strong view about the story so you can act on it. Buying something cheap is easier said than done, and acting on conviction is really what makes an investor a brilliant investor versus an average investor. Betting when you have that not certainty but conviction that something has intrinsic value is something that very few people are able to do, and that only comes with doing your own homework. That's the only reason why doing your own homework is important. So when you're in a position of fear, you're not calling people to ask their opinion about the asset. You have your own views and you can act on it. So those are important aspects, and I'm saying this because the volatility of the exploration side is tremendous. And you're going to be in that position. I don't care how smart you are, you're going to be in a very tough position at some point of your career where you're going to have to make those decisions. And conviction will be a very helpful way of allowing you to make the right choices at that point.
Great thoughts from both of you. Brien, I would like to hear your thoughts as well on the jurisdictional risk side of things. Do you generally tend to stick to so-called established jurisdictions, or are you more perhaps adventurous in where you might invest?
Yeah, I agree with everything, first off, that Tavi said, unsurprisingly. But yeah, the market adjusts for jurisdictional risk, and will have safer and more secure investments in North America and other jurisdictions that have built big projects before. But you have to look at it from the size of the prize, which Tavi also touched on. In some cases, you're willing to take on a little more risk because you see the potential for proving up something that can be really, really sizable, really a generational discovery. And sometimes you can have a better understanding, or believe you have at least, than the market on what the risk is in a certain jurisdiction. And you can take advantage of what may be unfounded risk discounts being applied toward certain jurisdictions. Another thing that's a factor that we are already seeing emerge in this bull market, but we'll see increasingly in this bull market because it happens every cycle, is the renegotiation, the nationalization, the confiscation of assets in various jurisdictions. When mining companies are making an awful lot of money, which they will be doing increasingly in a lot of these places in the world, the governments will look on them and say, I don't really care what the previous administration negotiated with you. You're making more than you should be, so we want a bigger cut of the pie, or we want all of the pie. And that's the kind of thing that will happen. So you have to be mindful of that. Mitigating that, of course, is your investment horizon, if you're buying a project that has a 20-year mine life, you're only buying for a small slice of that. In the juniors, probably well before it goes into production. So you're looking at that jurisdictional risk, that political risk. You only have to have that situation hold together for maybe a year or two for the typical time horizon. Maybe a few more if you're, looking at a bigger project. So it is so much project dependent, and you need to factor all of this in and get your own view of that jurisdiction. The easiest thing for people to do is diversify jurisdictionally, so you don't have all of your eggs in a number of companies in an area play that's in a riskier environment. And if there's a coup, you lose everything. So you need to concentrate or focus on diversifying as well.
Well, let's end on discussing stepping outside of the precious metals and discussing any other commodities that you're both currently seeing an opportunity in. Tavi, I'll start with you.
Just to finalize the thought from the last question, and I'll enter in this last one. I would just say that going to these conferences can be very helpful. By the way, it's a good discussion to hear from different views. You're going to see that some really smart people have, very drastic different opinions in this part of the industry, but they all have their own way to skin the cat. And so, I find it helpful to listen to them as well. So if you haven't been to either the Cambridge one in Vancouver or Brien's conference in New Orleans, those are wonderful places for you to go. Now, and I'm saying this, I'm not connected to them in any way. I'm just saying this as an investor. So just so the audience knows. On your question, I am extremely actually. I'm starting to gain a lot of conviction on one thesis, which is energy. I think, I'm a big believer that when you get into a commodity cycle, you have these moments where commodities kind of rotate, and you have, the lumber prices were hot and then they're not hot anymore. And then you have natural gas went up a lot. Then ammonia prices went up a lot. Then you had agricultural prices went up a lot. Then orange juice prices went up a lot. Then recently copper was the new king, and everyone was referring to that. And what's the flavor of the day now? It's gold. And actually silver is starting to steal that place from gold more recently. And so pay attention to these things, because that doesn't mean that the ones that have not performed recently are at the end of their cycle. That just means they're probably likely to start moving again. And when I look at the oil prices specifically, natural gas too, but oil is really interesting, because if you're of the view that inflation is somewhat starting to reaccelerate here, and that's mostly because of the Fed being forced to cut rates by all the reasons I said in the beginning, or the fiscal challenges that I think all of us agree, and having to do that in a place where inflation is highly entrenched in the economy. So we have not fixed the supply problems in the commodity side. So the energy commodities are likely to reemerge. And I'm paying close attention to oil specifically. It wouldn't shock me at all. Everyone is saying oil is probably going to go back down to $30 a barrel, when I actually think the path to $100 a barrel is much more likely than the other way around. And I love when majority of the people disagree with me. And when I look at the gold to oil ratio, I love gold. I'm coming here to talk about precious metals and other metals. But when you look at the gold to oil ratio at one of the largest levels in history, the only other time was higher was when oil went negative, which probably shouldn't count in this point, but it was also a major bottom for oil at negative prices. Is now. I mean, it really haven't seen anything like this as extreme. So I do think that there is a real risk to the economy that oil prices could go a lot higher. And I think energy companies are resilient, extremely resilient, despite this weakness in oil recently. You look at the divergence between the two, you should notice that that has been happening for some time now. And I do think oil is probably has a catch up, opportunity, not only with other commodities, but also with energy companies too. So I am on the record that I'm very, very bullish on energy right now. I do think it's almost as interesting as gold at this point. So, if not more. So I'm extremely bullish in that space.
You are preaching to the choir, my friend. I have to stop myself from buying more oil and gas equities because I am already perhaps irresponsibly overweight, at least according to traditional financial managers. Brien, what are you looking at right now outside of the gold and silver space?
Well, when Tavi mentioned energy, I thought he was going to launch into a spiel on energy metals, which is another area. And, it really is a target-rich opportunity we have here. But I think that in particular, copper is one of the energy metal I think that you can't innovate around. It all comes down to copper. If you believe in the electrification of transportation story, you got to believe in copper. But the key to copper right now is that a combination of base case demand, throwing all of that electrification, AI, energy, all of that stuff out the window, just the current base case for copper. You still have a copper supply deficit of significant size developing and running into a very significant supply constraints. We have great visibility on copper supplies going out for years, and there ain't enough under any scenario, not nearly enough. So if you do believe that there is something to be said for that all electrification and rebuilding of the energy grid story, even a fraction of what the predictions and forecasts are, then the story gets to be one of the most compelling that we've ever seen of any commodity in recent history. So it's a little bit harder to play copper in the junior space because typical copper projects demand a big partner with deep pockets. But there are some discovery levels. We saw Philo taken out recently. That was a big success in our newsletter. So there are some, but I look at copper as for entirely different reasons in gold and silver, as a set it and forget it theme. Find a few good companies, well managed, well capitalized, well financed, and the ability to raise money with good projects. Buy them now and wait a few years, and then look at them, and you should be pleasantly surprised.
Well, gentlemen, fantastic conversation. So many insights shared. Greatly appreciate your time. Let's talk about the New Orleans Investment Conference coming up. Brien, you're putting it on. Tavi, you'll be speaking at it. Brien, just give us an overview of what the conference is all about, when it is, and how people can get tickets.
Yeah, thank you for my favorite topic, one of my favorite topics. New Orleans Conference is the oldest investment event in the world. We're celebrating our 50th anniversary this year at the beginnings, the dawn of a secular bull market in metals and mining. And if there's one unassailable truth in investing is this is where you want to be at this point in a cycle. And so it's a big year for us. Tavi is unable to be there in person, but he will be contributing an exclusive virtual presentation for our people, as well as Lynn Alden is doing the same thing because she can't travel this year. But other than that, we have James Grant, George Gammon, Rick Rule, Danielle DiMartino Booth, Brent Johnson, Jim Iorio, Peter Bookvar, Jim Bianco, James Lavish, Dave Collum, Tracy Schuchart, Avi Gilbert. Just the list goes on and on. Dozens and dozens of today's top experts.
Yourself?
Yeah, and yours truly as well. Thank you, Tavi. I appreciate that. Your check's in the mail. But yeah, I'll be there, and we'll be giving my top picks and strategies and some insights on the market as well. And great companies, dozens of the top companies in the market today in the metals and mining will be there. And a lot of great attendees, people you can share your views with and have a lot of great insights to share with you. It is a remarkable event that has to be experienced to really be understood. And I urge everyone to go to neworleansconference.com to learn more about it.
Great. I'll put a link in the description below for people who want to check that out. And Tavi, tell us about Crescat Capital. Anywhere else you want to direct people online, feel free to as well.
Sure. If you're really bored, you can go to my Twitter and at Tavi Costa and look at some charts and some quick thoughts about my views, at least on the macro side. And also, we put out letters every once in a while, almost monthly. I write it every 2 months myself. You can kind of tell the difference of the letters. Mine are a little longer usually, and but write about most of the views that we view that we think are critical here when it comes to deploying capital for the following years. No, we our goal is always to kind of identify these kind of big macro trends and try to establish ourselves into those trends the best way as possible. One thing I didn't even discuss today was emerging markets, and it's another place that I think it's really interesting part of the market that could be a big winner for the following years. But nonetheless, if you're if you're interested in those topics, I'll go to crescat.net, and that's more about us. And but that's it about myself. I don't have as much of a cool insight as all these other guys, including Brien. But if you're bored, as I said, go to Tavi Costa on Twitter, and you will fall asleep.
I've got to correct that. If you follow, Tavi is one of the best follows in the market. I have an eye for talent. He is the best. He is the best chart meister you'll find out there. His insights and his charts are so fascinating and compelling. Please, if you follow anybody in social media, follow Tavi's insights. They're incredible.
Hey, thank
Absolutely
you, Brien.
agree. And a
Wish
very
my wife would
popular
agree with you.
account. Well, many people do. You've got a super popular account on Twitter. So I'm going to put a link to that as well as Crescat. Brien, I'll put your Twitter account in the description below as well. Thank you once again, gentlemen, for coming on the show. It's been a blast.
Thank you, Jesse.
Thank you.